Good morning. For today's activity, I will be discussing the fundamentals of financial statement. At the end of this module, you should be able to explain the importance of financial statement in a business. You should also be able to learn how to identify FS accounts and prepare financial statement. So, are you ready? Then let's begin. For this module, we are going to have the overview of financial statement. Define financial statement, what are its uses and its importance. Now, we are also going to try preparing the three types of financial statements: the balance sheet, the income statement, and the cash flow. Now, before we dig deeper into the fundamentals of financial statement, we should first learn the basic accounting equation. Now, do you know what is it? Okay, so it is asset equals liability plus owner's equity. Now, this is the very basic thing you need to know before analyzing a financial statement. Now, let's discuss each element, okay? First off, we have asset. So, asset is something that is owned by the business. So, here are some examples of an asset. We have here cash. Cash could either be cash on hand or cash in bank. We also have here land and receivables. Receivables are those credit transactions made by the company or made by the business. We also have here furnitures. Inventory. Inventory, these are supplies or items that are not yet sold or basically supplies on hand. Last thing is a building. Now, let's go to liability. Liability, this this is something that the company owed. Okay, so the difference between asset and liability is that the asset, this is something that is owned by the company, while the liability is being owed by the company or by the business. So here are some examples of a liability. We have here accounts payable and the notes payable. So these are both our debts incurred by the business that should be paid within the given period of time. And lastly, we have here the owner's equity. So owner's equity is something that the owner can claim from the business, or in other words, it is the capital of the owner. So some examples here are dividends, dividends, and the retained earnings. So both are profits made by the company, but the difference is that dividends are profit being distributed to its shareholders, while the retained earnings are profit that the company chose not to distribute to its shareholders. Another example of an owner's equity is the outstanding shares. Outstanding shares, so these are the company's shares being held by all its shareholders. To move on, let us learn something about financial statement. So, what is a financial statement? So these are the reports that summarize important financial accounting information about the business. So, in other words, it conveys the business activities and the financial performance of a company. So these are the documents that you need to have in order for you to know and assess the financial capacity of the business. Financial statements are often audited by government agencies, accountants, and firms to ensure accuracy for tax, financing, and investing purposes. So financial statements have three main types. So we have here first the balance sheet, the income statement, and lastly, we have here the statement of cash flow. Balance sheet. So balance sheet, it provides a snapshot of a firm's financial position at one point in time. So it also provides an overview of the company's asset, liabilities, and owner's equity. Now for some, they also call these documents a statement of financial position. From the name itself, balance, meaning to say you have to apply the basic accounting equation in this report. Remember, the asset equals liability plus owner's equity. Okay, now let's take a look at an example of a balance sheet. Okay, so here is an example of a balance sheet. First thing you need to do when you construct a balance sheet is you write down the heading. First is you write down the name if it is a sole proprietorship. If it is a corporation, you write down the name of the company. Okay, you write down here the balance sheet and then the period wherein you're making your report. So here in this example, we are making the report as of December 31, 2011. So let's go down. Let's examine the data that should be included in this report. First is we have the assets. Now, if you can observe, there are two kinds of assets in this report. We have here the current asset and the non-current asset. Okay, so the current asset are those assets that are expected to be used, consumed, or sold within the accounting year or within 1 year. So example of that is cash, accounts receivable, and the prepaid expenses. Now, M. Santos here has a total current asset of 343,000. Now, for the non-current assets, non-current assets are those assets that are expected to be sold, used, or consumed beyond the accounting year or beyond 1 year. So basically, example of this is the computer equipment. So as we all know, computer equipments are being used or consumed not just within 1 year, but it can be used for several years, okay, for the benefit of the company. Now, if you can observe, there is an accumulated depreciation here because accumulated depreciation is a contra asset that offsets the value of a depreciating asset. Now, an example of depreciating asset here is the computer equipment. So, the 1,667 pesos rather depreciation is being deducted to the original value of the computer equipment of 100,000. So the new value of the computer equipment is already 98,333. So M. Santos has a total asset of 441,333. So let's go to the liabilities and owner's equity. Now, same with asset, liability has two kinds also. It has current liability and non-current liability. Current liabilities are those liabilities or debts that are expected to be paid within 1 year, while non-current liabilities are those liabilities or debts that are expected to be paid beyond 1 year. So here in this example, M. Santos has only one kind of liability and it is only the current liability. So example of current liabilities are accrued expenses, loans payable, and the income tax payable. So M. Santos here has a total of 114,919 pesos liability. Now, let's go to the owner's equity. M. Santos, because it is a sole proprietor kind of business, so it has only one kind of owner's equity. So that is M. Santos Capital. And then it has a total of 326,414. So if you add up the liabilities and the current owner's equity rather, it will have a total of 441,313. Now, going back to the equation, asset equals liability plus owner's equity, we have a balanced equation here. So, meaning to say, we have an accurate balance sheet. So income statement. Now, income statement, it summarizes a firm's revenues and expenses over a given period of time. So, unlike balance sheet, the income statement covers a range of time, which is a year for annual financial statements and a quarter for quarterly financial statements. So, for the formula of income statement is as follows. So, here you have net income is equal to revenue less expenses. Now, let's take a look at an example of a financial statement or an income statement rather. So first off, we should write down the name of the company or the name of the owner if it is a sole proprietorship. Next is we should write down the type of financial statement that we are making. Here we are preparing the income statement. And then for the third row, we are going to write down the period. So here we are making the income statement for the year ended December 31, 2011. Okay, so now let's discuss each accounts in the income statement. First, we have here sales. So sales, it refers to the operating revenue earned by the company by selling their products or services. Now here, Snapit company has a total sales of $4 million. Okay, next account is the cost of goods sold. Cost of goods sold, it refers to the direct cost of producing the goods sold by a company. So this includes the cost of materials and labor directly used to create the goods. Okay, so for Snapit company, it it has a cost of $3,040,000. So if we deduct the cost of goods sold from the sales, we can get the gross profit of $960,000. So what is a gross profit? So the profit a company makes after deducting the cost of goods sold or after deducting the cost associated with making its product or cost associated with providing its services from its sales. Okay. Now let's go to the selling and administrative expenses. Okay. So this is the sum of all direct and indirect selling expenses and all general administrative expenses of a company. So this includes the cost to sell and deliver products and services and the cost to manage the company. So here we have a total selling and admin expenses of 430,000. So we have here an operating profit of $530,000. Now what is an operating profit? An operating profit is also known as earning before interest and taxes or EBIT. Now, this is an indicator of a company's profitability. So by showing or by getting the EBIT or the operating profit, we can assess if the company is gaining or if the company is losing from its product or from its shall we say services that the company is offering. Okay. Next is the interest expense. Interest expense, so this is the cost incurred by an entity for the borrowed funds. So this is a non-operating expense. So that is why interest expense is not included in the selling and admin expenses. Okay, so again, this is a non-operating expense that is being shown in the income statement. So here, Snapit company has a total interest expense of 160,000. So it has an income before tax of 370,000. So next is the tax expense. Okay, so the tax expense here, this is the amount of taxes owed by an individual, corp, or other entity to a taxing authority. Okay, so for here, Snapit company has a $148,000 tax expense. So here, get the net income. So we have here a $222,000 net income. So net income, this is the company's total profit after deducting all business expenses. So here is the business expenses that the company has incurred. Okay, we have here the last type of financial statement, and that is the statement of cash flow. Now, the statement of cash flow reports the impact of a firm's activities on cash flows over a given period of time. Now, it also measures how well a company manages its cash position. This means how well the company generates cash to pay its debt obligations and fund its operating expenses. Now, the cash flow statement complements the balance sheet and income statement, but it is very important to take note that the cash flow statement is distinct from the income statement and balance sheet because it does not include the amount of future incoming and outgoing cash that has been recorded on credit. Now, therefore, cash is not the same as the net income, which on the income statement and balance sheet, it includes cash sales, and sales made on credit. Okay? Now, there are three main components of a cash flow statement, and these are: first is the operating activities, second is the investing activities, and third is the financing activities. Now, there are two methods of calculating cash flow. Now, before that, I'll be showing you an example of a cash flow statement. Okay, the two methods of calculating the cash flow is the direct method and the indirect method. The direct method is basically the cash inflow less the cash outflow, and you will get the net cash flow. In this module, we're going to discuss the indirect method of preparing the cash flow statement. Now, in this method, cash flow from operating activities here. Okay, so cash flow from operating activities is calculated by first taking off its net income. Okay, taking off its net income from the company's income statement. So here, we get the net income from its income statement. So the Bob's Donut Shop has a net loss of 6,050. Okay. Now, since the company is preparing its financial statement on an accrual basis, so what is an accrual basis? This is a method used in accounting where revenue or expenses are recorded when transactions occurs, either payment are made or not. Now, since the financial statement is prepared on an accrual basis, therefore, the net income is not an accurate representation of the net cash flow from operating activities. So again, as what I've said a while ago, net income is not the same as the net cash flow. Okay? Now, in this method, it also makes adjustments to add back non-operating activities that do not affect a company's operating cash flow. Now, one example for that is depreciation expense. Okay, so depreciation expense, this is an account that is not necessarily, or that is not a cash expense. So basically, depreciation expense has no cash transaction, or it does not involve any cash when you record a depreciation expense. Okay, so you add that back. So if you can see here, you add the 500, so you have a changes of negative 5,550. Okay, so let's go to the activities under the operating activities. Okay, first, what is an operating activities? So it includes any sources and uses of cash from the business activities. So in other words, it reflects how much cash is generated from a company's product or services. So in the operating activities, if we can observe here, um, the current assets, which are accounts receivable, prepaid rent, and inventory, and the current liabilities, which includes accounts payable, accrued expenses, and unearned income are being presented or being included in the operating activities in the cash flow. So let's go it let's go discuss it by details. So here, increase in accounts receivable. It is a cash outflow since the company has paid for the cost of its product and the sales has been made on credit. So this is a negative, or it is a deduction from the cash flow. So it is an outflow. Same with the prepaid rent. Prepaid rent is also cash outflow for the company since the company has paid another advances for its rent. Next is the inventory. Now same, it is also an outflow since it has bought an additional goods to prepare for its product. Okay? So if you can observe, when there is an increase in the current assets, it is a cash outflow. So otherwise, if there is a decrease in the current asset, it is a cash inflow. Okay, now let's go to the current liabilities account. First is the increase in accounts payable. Now, basically, or definitely, when there is an increase in accounts payable, there is an inflow, or there is a cash inflow for the company since it has generated a cash from the short-term loans that the company has applied for. So here, there is an additional $19,000. Next is the increase in accrued expense and unearned income. So again, it is also an inflow since the company has not yet paid its expenses, but has already used it, or it has not yet rendered its services, but the customer has already paid for the revenue. Okay, now again, if you can observe, when there is an increase in the current liabilities, there is a cash inflow. Otherwise, um, if there is a decrease in the current liability, definitely there is a cash outflow. Okay, so here the net changes in working capital is 6,150, and then the total cash that the company has generated from its operation is 600. Okay, now let's go to the investing activities. Now the investing activities here, it includes any sources and uses of cash from a company's investment, such as the purchase or sale of an asset or any payment related to a merger or acquisition. So in other words, changes in equipment, asset, or investment relates to the cash from investment. Now in this component, the long-term or non-current assets are being included in this activity. So if you can observe here, renovations and improvements, this could form part, or this could be part of your long-term assets. Now, when a company renovates, or when a company has improvements to its building or in its land, let's say, um the company uses cash, definitely. So because of that, there is a cash outflow. So in other words, it is a deduction from the cash flow statement. So here, the cash from investing is a negative 25,000. Now, but there is a cash inflow for investing activities if there is a sale of an equipment or a sale of a fixed asset or long-term asset. So here in this example, it only has a cash outflow for the renovation and improvements of the company. Okay, next is the financing activities here. The financing activities, it includes the sources of cash from investors or banks, as well as the use of cash paid to shareholders. So payment of dividends, payment of stock repurchase, and repayment of debt principals are included in this component. Now, in this component, equity and long-term liabilities are being included. Okay, long-term liabilities such as bonds are part of the financing activities. Okay, now issuance of common stock. Basically, when there is an issuance of common stock, there is a cash inflow for the company. It receives cash from the shareholders. And then issuance of long-term liability. When the company issues long-term liability, again, such as bonds, um, the company generates cash from its bondholders. So a positive $24,500. Now, when the company pays its dividend to its shareholders, so definitely the company is using its cash to pay for its dividends. So that is a cash outflow. So it is a negative 500. So we have here a cash from investing, a positive $74,000. Now, here we will add up 600 plus 5 plus or minus $25,000 plus $74,000. It has a net increase or decrease in cash flow of 49,600. Now, assuming that there is no cash balance or no cash balance at the beginning of the year, so here it's 0. So the closing cash at the end of the first month of 2020, or at the end of January 2020, it has a positive 49,600. Okay. Okay, so let's try another example of financial statement. So here, we're going to prepare a comparative financial statement of the Leon Corp given the following data. Okay, so these are the data that we will be using for the preparation of the comparative financial statement. Okay, if we can observe here, there are 2 years, 2 dates, the year 2002 and 2001. Now again, we are making a comparative financial statement. So basically, we will be going to have at least 2 years when we prepare a comparative financial statement. Okay, so before anything else, we shall first identify what financial statement they're included in. Okay, so these accounts could be part of either balance sheet or the income statement. Okay, first, in the balance sheet. Okay, balance sheet, it includes here from cash up to the retained earnings. Okay, now in the balance sheet, again, there are 3 components. We have there the asset, liabilities, and the equity. Now for the asset, we have from cash up to the accumulated depreciation. Now again, in the asset part, we have 2 types of assets. Okay, we have the current asset, which includes the cash, accounts receivable, and inventories. Second is the non-current asset, which includes the fixed asset and the accumulated depreciation. Next is the liabilities. The liabilities, same with the asset, it has also 2 types of liabilities. First is the non-current liabilities, current liabilities rather, which includes accounts payable, notes payable, and accrual. And then the non-current liability includes the long-term debt. Okay. Next is the equity. Here in the equity, we have the common stock and the retained earnings. Now, another type of financial statement that we will be preparing is the income statement. Okay, for the income statement, we have here from sales up to the lease payments. Now, in the income statement, we will be using the sales, cost of goods sold, depreciation, interest expense, taxes, and these are other important details that we need to create or to calculate the net income. Okay, now for the next slide, we will be preparing each financial statement for the Leon Corp. Okay, let's prepare the balance sheet. Okay, we have here the given data. Okay, and also we have included the other data that could be used in preparing for the balance sheet. Okay, first is we will write down the name of the company, De Leon Corp. Second is a comparative balance sheet, and third is the period. So we have here December 31, 2001 and year 2002. First off, we will be computing for the total asset. So here we have cash, accounts receivable, and the inventories. So we have a total current asset for 2002 of 1,926,802 rather, and for 2001 we have 1,124,000. Now for the non-current asset, we have here again the fixed asset and the accumulated depreciation. So we have a total of 939,790 for 2002 and 344,800 for 2001. Now we have here a total asset of 2,866,592 and 1,468,800 for 2001. Okay, let's go to the liabilities and equity. Okay, for the liabilities, we have here the total current liabilities. We have the accounts payable, notes payable, and accrual. Okay, for the total liabilities or total current liabilities rather, we have a total of 1,650,568 and 481,600 for year 2001. Now we have also here a long-term debt of 723,432 and 323,432. So we have a total liability of 2,374,000 for year 2002 and 805,332 for 2001. Here we have, for the equity, we have the common stock and the retained earnings. For the common stock, we have here same for year 2002 and 2001, 460,000. This is because they're assuming that there was no new issuance of common stock for the company. And the retained earnings, in 2001 we have 203,768. So this is how we get the retained earnings for 2002. Now for the retained earnings, we have here 203,768, and on the next part of this slide, we will be having a net income of 160,176, and then we will be deducting the dividends paid of 11,000. Why 11,000? Because here in the data, in 2002, the DPS or the dividends per share is 0.11. So that is 0.11, and the number of shares here is 100,000. So 0.11 times 100,000 is equal to 11,000. So we have here a balance of the retained earnings of 32,592. That is why we have a 32,592 here. Okay, now we have already a total equity of 492,592 for year 2002 and 663,768 for year 2001. So here, for the total liability and equity, so we add up the total liability here plus the total equity. So we have a 2,866,592 for year 2002 and 1,468,800. So to check if we have a correct balance sheet, we will be looking at the asset. Again, remember the equation: asset equals liability plus equity. Okay, so here the asset is 2,866,592 and the total liability and equity is 2,866,592. So definitely we have the correct balance sheet. Okay, income statement. So here in this slide, we'll be preparing the income statement given the following data. Okay, first is write down the name of the company. then the comparative income statement, and then the years ended 2001 and 2002. So here is the presentation for the income statement of the Leon Corp. So first, here is sales, and then we will be deducting the cost of goods sold. So we have here a gross profit of 506,000 for 2001 and 568,000 for 2001 rather. 506,000 for 2002. Now here, other expenses, now it includes the selling and administrative expenses. We have 590,988 for 2002 and 2001, 358,672. So we have an earnings before interest, tax, depreciation, and amortization for 2002 of negative 13,988. And for 2001, we have a 209,328. Okay, so for 2002, we have a depreciation and amortization of 116,960 and a 18,000 for 2001. So here we can get the EBIT, or the earnings before interest and tax, of negative 130,948 for 2002 and 190,428 for 2001. Now for the interest expense, we have here 136,012 for 2002 and 43,828 for 2001. Now, we can get the earnings before taxes by deducting the interest expense from the EBIT. So we have here for 2002, we have negative 266,960 and 146,600 for 2001. Now for the taxes, here by using this data, we have a 40%, the company is using 40% tax. So basically, we compute the 40,000 based on the earnings before tax. So negative 266,960 multiplied by 40%, that is negative 106,784. And for 2001, 146,600 multiplied by 40%, that is 58,640. So De Leon Corp has a net income of negative 160,176 for 2002 and 87,960 for 2001. Okay, for the statement of cash flow. So again, the statement of cash flow, as what I have said a while ago in the previous slide, it complements with the balance sheet and the income statement. So basically, the data that we have generated from the balance sheet and income statement will form part for the preparation of our cash flow. So here, we will be having, or we will be preparing the statement of cash flow for De Leon Corp as of December 31, 2002. So first is the operating activities. So operating activities, we have here the net income with negative 160,176, okay, and the depreciation of 116,960. So increase in accounts payable, so 524,160 minus 145,600, so that is 378,560. An increase in accruals, which is 489,600 minus 136,000, so that is 353,600. Now again, when there is an increase in the current liability, that is a cash inflow for the company, okay? Because the company gets or generates cash from the loans that they were applying for. And then for the current asset, when there is an increase in the current asset, the company is utilizing its cash. So basically, that is a cash outflow rather. So when there is an increase in accounts receivable, 632,160 and less 351,200, so it has a increase of 280,960. So that is an inflow, so it will be a deduction from the cash flow. Increase in inventory, so 1,287,360 less 715,200. So that is an increase of 572,160, or a deduction or a cash outflow for the Leon Corp. So for the total cash provided by the operating activities, it has a negative 164,176. Now let's go to the investing activities. So here, investment in fixed asset. So if you can observe in the fixed asset, it increased by 711,950. So basically the company has bought rather a new equipment, let's say, worth 711,950. So the total cash provided by investing activity is negative 711,950. Now let's go to the financing activities. Now for the financing activities, we have here increase in notes payable. Now as you can observe, notes payable is part of the current liability. Now for some companies, they classify the notes payable as part of their financing activities in their cash flow, because notes payable are interest-bearing accounts or interest-bearing debts. Okay, so to make it simpler, notes payable in our succeeding activities, we will be classifying the notes payable, or we will be including the notes payable in the financing activities for the cash flow. So we have here an increase of 436,808. Next is the increase in long-term debt of 400,000, and then the payment of cash dividend here, that is 11,000. Okay, so we have a total cash provided by FA of 825,808. So we have a net change in cash of negative 50,318, and we have here a cash beginning of 57,600. So we have here a cash end of 7,282. So we have a total or a balance cash for 2002 for the balance sheet. So that ends the part 1 of module 1. So I hope you have learned something from our discussion. And for the next topic, we'll be having the financial statement analysis. So that includes the ratio analysis. So I hope you study in advance. And that's it. Thank you and have a good day.